Hedge fund managers earn their bread by analyzing and investing in the growth of assets, such as land, real estate, stocks, derivatives, and currencies. And the most common and long-term strategy isn't predicting the growth of companies, which is stock picking. A more sophisticated term is equities, that can grow in value and strength in a short to a long period of time, depending on its strategies. They look at the company's balance sheet and tell almost near perfectly where it will be in the next few months or up to a year or so. Are you an investor who wants to earn money by investing in stocks, just like hedge fund managers? The crucial skill in excelling and making a gain in it is to first understand how to analyze a balance sheet. You will then be able to read its profit and loss, cash flow, etc. in order to make an informed investment decision on the company's growth by understanding how they perform versus what the company promises to their investing public. Do you want to emulate the best in the stock market and find a hack to predict as well as hedge fund managers? Stay tuned to dive deep into it. Do you think that stock market is just an unpredictable beast that requires a lot more stroke of luck? Well, today's video will help you understand how you can bring method to this madness and be more resourceful and cautious when investing your hard-earned money. Before we begin, please do note that this is not professional financial advice, but purely our opinion based on our own research. A company's balance sheet can provide you with so much important information that can make or break your investments. For example, suppose your analysis shows that the company doesn't have enough assets to pay out its debts, or otherwise they don't have enough liquidity to run its day-to-day operations. In that case, there is a chance that the company will go under soon. This means that your investment in the company might also tank along with the company. A company's balance is also divided into 3 different sections, which are number 1, the assets, number 2, the liabilities, and number 3, the shareholders' capital. Assets are any resource that is owned or controlled by the business. It can be anything that can be tangible, like a factory, or intangible, like a patent that can be used to produce positive economic value for itself. In financial accounting, a liability is defined as the future event where economic benefits will need to be diverted by the company towards an obligation as a result of past transactions or other past events, the settlement of which may result in the transfer or use of assets, provision of services, or another yielding of economic benefits in the future. This can mean anything from a bank loan to debentures. Finally, the shareholders' capital is the one that is provided by the likes of you and many other investors investing in the company and waiting for dividends, amongst other things. There is a further division where assets and liabilities are broken into current and non-current assets and liabilities. The assets which are so liquid that they can be easily realized within a year are called current assets. At the same time, those which are not liquid and cannot be easily realized are called non-current assets. Liquidity is the measure of assets and the period that might be required to convert them into cash. The most liquid assets are shown on the top left-hand side of the balance sheet. And then as you go towards the bottom of the balance sheet, the final asset mentioned will be the least liquid asset. Hence, cash and cash equivalents will be mentioned first in a balance sheet as they are the most liquid form of assets. This is why the current assets are mentioned first, followed by the non-current assets, while anything is ranging from property or factories will come to the bottom. Similarly, the current liabilities are required or possibly will be paid within 1 year, while non-current liabilities cannot be paid off within 1 year. So, this is a breakdown of the basic understanding of the balance sheet. Another thing to remember is that the company's assets are financed by the liabilities and the shareholders' capital. So then, let us begin understanding what it is that you should be looking for in order to be able to analyze a balance sheet like a hedge fund manager. Step number 1. Assets. Cash and cash equivalents are the first items found under the assets. Cash equivalents are very safe investments that are greatly liquid, meaning they can cash out immediately or very easily, therefore, easy to convert to cash. This investment is very low risk but also has some interest they can earn on it. For example, if there is $1 million invested by a large company in a low-risk small investment, and they earn 3% per annum on it, that means by the end of the year, they pay $30,000 on it, which is a huge amount in itself, with little or no effort. We will start our analysis from something mentioned in the balance sheet as marketable securities. These headings consist of securities such as government bonds, and it will be helpful for us to calculate the overall true cash. For the calculation, let us take Apple's balance sheet for March 2022 in millions. We can see that Apple has had cash and cash equivalents of $28,098, added with $23,413 of current marketable assets and $141,219 of non-current assets, which means the true cash of Apple Co. in March 2022 was $192,730. This is the amount of cash that can be used by the company to pay back its debt or buy more assets. Then we look at accounts receivable, which is the amount of money that the company will receive as they sell their products on credit. This shows the number of customers that are yet to pay the company. Inventories are also products that are ready and need to be sold. If there is a steady rise in its value, then it means that the company is unable to sell its products, and it is not a good sign for its investors. Microsoft in 2013 was a prime example, as they had a loss on their inventory worth $900 million because they overestimated the market demand. Supposedly, you are investing in a retail chain. In that case, this is a very important aspect, as mismanagement of inventory might mean that you, as an investor, may struggle to keep your investments from going down the drain due to missing these details in the balance sheet. Let us move on to the final point in the assets balance sheet. That is the PP&E plant, property, and equipment. These assets will remain with the company for more than a year and are non-current assets. This can be an indicator of how capital-intensive the industry in which the company is functioning within. So the way to determine this is by using the following percentage, where PP&E is divided by net sales. For Apple in March 2022, 6 months ended in millions, going to PP&E equals $39,304 and net sales $97,278, which will be 17.76%, which is comparatively lower compared to other industries. Step number 2. Liabilities. The first account in the balance sheet that a hedge fund manager will look at is accounts payable. This is the liability that any company will acquire when they get services and products from other companies that supply them and have not paid them back yet. Hence, the products and services they have received on credit. So, for example, Apple in March 2022 owes under accounts payable around $52,682. The next item is deferred revenue, which is revenue received before the service has been rendered. For example, when you pay $5.99 for Hulu, the company cannot show it due to the principal followed in accounting. Commercial paper is a month-long debt that has been repaid in that time. Now, in the same way, we calculate a company's true debt, and here again, let us take Apple in March 2022. We will add commercial paper worth $6,999, term debt worth $9,659, and term debt of non-current type worth $103,323. After calculating them, we will get $119,981 as a true debt of Apple in March 2022. Step number 3. Net debt cash. The next step is to make sure that you calculate something called the net debt, which can be arrived at by finding the differences between the true debt calculated earlier and the true cash calculated. In March 2022, if we calculate, we can determine a difference between $119,981 million and $192,730 million. The difference, which is a negative $72,749 million, is Apple's true debt, which means that there is more cash than debt. This means even though Apple has a debt of $119,981 million as their debt, now they also have the liquidity to easily pay off the money, and therefore, it is a healthy company to invest in the long term due to the stability that the balance sheet can see. Step number 4. Identify the significance of debt. So, how do you understand which figure of net debt should be problematic and which debt figure should be able to inspire the desire to invest in a company. If a company can make profits of close to $100 million, then debts close to $10 million are quite insignificant, and therefore there is no need to worry as an investor. Imagine at the same time that a company has yearly profits of an estimated $1 million only. They too have the same amount of debt then. This debt could be already crushing the company. Therefore, it is important to pull out of the company if you have already invested money. The lesson here is that it is important to look at the company's debt from the perspective of its earnings. So, if you want to know whether a company can sustain its debt, it can once again be calculated before you use the net debt to EBITDA ratio. To calculate the same, you need to enter the company's income statement, calculated by subtracting all expenses except interest, taxes, depreciation, and amortization from net income. After then, divide net debt by EBITDA ratio. On the Shareholders Capital side, you can find out the ratio called Return on Investment, ROI, which measures the amount of time it takes for a company to earn its investment back in the years and how it can use it efficiently. All you need to do is divide net income by shareholders' equity, and you will have the ROI. While doing this exercise, you should make sure that you can compare stocks within their industry and not outside of it. With that, we have come to the end of the video. Join us on the next one. Bye-bye.